You know, there are some summers where the biggest headline is literally just whether the water at the beach is too cold. And then there are summers where the Spanish banking sector decides to script its very own blockbuster action movie. Last year, absolutely everyone was talking about BBVA's takeover bid for Banco Sabadell. I mean, it was treated like the World Cup final. We had analysts everywhere, experts frantically drawing arrows on stock charts, and shareholders checking the stock price way more often than the weather report before heading out to the coast. But well, the headlines have faded and the dust is finally settled. So in this explainer, we're going to unpack exactly how this whole summer saga ended, and honestly, more importantly, what it means for the future of banking.
Right, so the crucial point is figuring out what actually happened when October rolled around and put a hard stop to this entire story. Just like after any massive battle, it was finally time to tally up the damages. And what we found when the smoke cleared? It was actually pretty shocking to a lot of people who'd been following the drama day in and day out.
Because look, the widespread expectation was that BBVA would come out of this severely damaged. After failing to pull off the operation exactly as they had initially planned it, people were bracing for impact. But the reality? Absolute calm and continued growth. The market did what it honestly does best. It completely contradicted everyone. Because let's face it, the stock market has a very, very strange sense of humor.
Our source material actually captures this dynamic with a perfect metaphor. It says, when everyone buys floaters because a wave is coming, it turns out there is absolute calm. When everyone expected a massive crash, the market just went up. BBVA simply turned the page, and surprisingly, the market did the exact same thing. Once that takeover was officially closed, investors just completely stopped obsessing over whether BBVA would buy Sabadell.
And here is the real plot twist of the story. A lot of people thought Banco Sabadell would inevitably disappear, right? Just swallowed up by another banking group. But no way, that didn't happen. Instead, both banks closed the chapter and just kept generating massive value totally on their own. Sabadell actually reinforced its independence, kept improving its bottom line, and maintained these incredibly attractive policies for its shareholders. The two banks went their separate ways, and they both thrived, which is a scenario almost literally no one predicted when the battle was at its peak.
So, with the dramatic takeover definitively off the table, investors immediately pivoted to a much more important question. How is BBVA going to keep growing now? I mean, if they aren't acquiring their biggest domestic rival, what is the game plan for the future? Well, the answer to that is fascinating, and it actually takes us way beyond the borders of Spain.
See, BBVA's true machinery is quite surprising. They remain one of the most profitable banks in Europe because their model depends less and less on the Spanish market. While everyone was exclusively watching the Sabadell drama, the real engine was humming along internationally. Think of BBVA like a beach bar, a chiringuito, if you will. From the outside, in Spain, it looks like this little stand just selling ice cream. But then you look closer at their revenue and you realize, wait, they also own the massive luxury hotel next door in Mexico, where they get a huge chunk of their profits. And they've basically rented out half the island with their growing presence in Turkey and other international markets.
With that global perspective, it becomes incredibly clear why major international funds are still betting so heavily on them. They stand out for a few really solid reasons. They have a highly elevated return on equity, meaning they are just incredibly efficient at generating profits from investor money. They boast super solid profits driven by that international business we just talked about. They have massive cash generation. And crucially, they are making a huge, aggressive push toward digitization.
Which brings us to the real pivot here. If they aren't buying physical banks, what exactly are they buying? Well, they are buying into the magic word of the moment: artificial intelligence. Today, absolutely no major bank wants to be left behind in this race.
Just think about it. A few years ago, banks would boast about how many physical branches they had on every street corner. Now, they boast about the number of algorithms they run. Honestly, pretty soon we're probably going to see slightly sarcastic ads popping up that say something like, "Our artificial intelligence will serve you before you even know you wanted to call." BBVA has made it crystal clear that their true objective isn't just merging with other banks anymore. It's becoming the absolute European benchmark for digital banking. And to get to that benchmark, they are pouring money into a very specific technological ecosystem. Let's just rapid-fire run through this aggressive investment list. They are doubling down on AI, obviously, but also heavy process automation. They want deep financial personalization for every single user. They're innovating in digital payments and open banking, which securely connects your financial data across platforms to give you better services. They are fortifying their cybersecurity, and this is really interesting, they're actively preparing for the future rollout of the digital euro.
So the crucial point of all this tech investment is actually very simple. Spend way less on red tape and bureaucracy and invest way more in the technology right in the palm of your hand. The ultimate dream here is that the customer can do virtually any financial operation from their mobile phone without ever having to hear that dreaded phrase, "Hold on just a moment, I'll transfer you to another department."
Now look, as much as we love talking about AI and digital euros, we absolutely have to address the favorite question of practically every retail shareholder watching the market. Simply put, when do we get paid? Let's talk about the dividends.
The golden number for shareholders right now is 40 to 50%. BBVA is maintaining its standard policy of distributing between 40 and 50% of its ordinary profit. They do this through a combination of cash dividends and share buybacks, which of course are always subject to board approval and how the bank's results actually evolve over the year.
And the schedule for this payout is something investors watch like a hawk. Typically, after the annual results are published, the bank announces a supplementary dividend in the spring and an interim dividend in the autumn. And let's not kid ourselves here. As our source playfully points out, there are investors who smile wider on dividend day than they do when they magically find a free beach chair right in front of the ocean without having to wake up at 6 a.m. It's a big deal. So when analysts look at BBVA's roadmap for the coming years, they generally point to four main engines. First, that robust international strength in places like Mexico. Second, maintaining those resilient, elevated profits even as central banks begin to normalize interest rates. Third, their relentless drive toward digitalization. And fourth, the engine that could quite literally define this entire decade, artificial intelligence. If AI truly manages to reduce their costs, improve customer service, and boost efficiency, BBVA could severely widen the gap between itself and other major European banks. Combine that with those share buybacks we mentioned, which naturally boost earnings per share, and you have a very potent formula.
Now, what's actually going to happen in the medium to long term? Well, nobody has a crystal ball. And honestly, if someone on the internet tells you they do have one, they're probably just trying to sell you a course on how to become a millionaire in 3 afternoons.
But what the market generally agrees on is that BBVA is starting from an incredibly solid position precisely because they understand this major transition. The next few years will absolutely not be dictated by how many physical, marble-floored branches a bank can open. The bank of the future will be decided by who offers the best digital experience, who integrates AI the fastest, and who adapts best to new payment systems and the digital euro. The war is no longer fought on the marble floor, guys. It's fought inside a mobile app.
Which brings us to what our source cleverly calls the morale from the beach umbrella. The dramatic takeover bid officially ended in October. The flashy headlines vanished, the spotlights turned off. But the truth is, the real game has only just begun. Now BBVA has to actually prove that it can keep growing without swallowing up its rivals, and that this massive bet on technological innovation is powerful enough to keep convincing the markets.
Because at the end of the day, the reality of investing is super simple. On the stock market, the winner isn't the one who makes the most noise. The real winner is the one who consistently generates profits year after year, quietly building value while everyone else is still loudly arguing about who won last summer's battles.
All right, a quick note of financial reality before we wrap up this explainer. This analysis is just that, analysis, peppered with a bit of market sarcasm. It is absolutely not financial advice, so always do your own research. If your portfolio ends up looking nicely tanned this year, hey, congratulations! But if it ends up redder than a sunburned crab, don't blame the beach bar. But it does leave us with one massive question as we look at the decade ahead. If the future of banking is entirely run by AI and algorithms, will the personal human touch of traditional banking eventually become the ultimate premium luxury? Keep your eyes on the algorithms, and we'll see you next time.